Good morning, everyone, and welcome to our Stocks Down Under weekly investor webinar. Good morning, Stuart. It seems like January has sort of flown by, really. It's already the 1st of February.
Right. The good news is we're 1 month into what we think will be a long bull market. I said bear, but I meant bull.
All right. Yeah, that's what we think. So let's jump straight in. So last week we started our webinar with our 3 favorite sectors for 2023, and we discussed the first one, which was technology. So have a look at that one from last week if you want to learn more about that. Today, Stuart, we're jumping into our second sector that we like for this year, which is life sciences.
Right. So 2022 was a bad year for life sciences. We got the presentation coming up then. Here we are. Yeah, bad year for life sciences. Every year I go to a particular conference called BioShares, and they put me up on the panel because I'm always bullish on this sector. And they introduced me to saying, and now someone who knows needs no introduction because he's always bullish. Stuart Roberts from Pitt Street Research. Stuart, how you feeling? And I told everyone to be bearish for 2022. And that was in May. And I think I wasn't proved wrong over the course of the next 7 or 8 months for the life sciences sector. Let me explain why. Now, Mark, you showed the slide last week. Our view on 2023 is it's actually going to be a lot better than 2022. The reason why 2022 was a bad year for the kind of sectors that you and I know in tech and life sciences is because inflation was too high, interest rates were going up, so the heat was going out of the more speculative stocks. This time around, we get the reverse of that. You'll see inflation coming down, peak of interest rates, and perhaps the beginning of the cuts. So long as we avoid a recession, or if the recession proves to be minor, we think we're in good shape for the life sciences sector. Life sciences got punished hard, and the reason is fairly simple. When I go to America, Americans talk about biotech the way we do about mineral exploration. It's where their marginal speculative dollar goes. Now, Americans over the years have managed to turn that marginal speculative dollar into some truly fabulous companies. If you go back to the 80s, with the first big biotech boom at that time, the genetic engineering revolution of the 1970s was turned into companies that subsequently became significant contributors to human health. I'm thinking of companies like Amgen, for example, or Genentech before it got completely bought by Roche. Every year, another company with a groundbreaking drug gets over the finish line at the FDA and starts selling that drug and turns into a real company. So this sector gets more and more robust. But every now and then it goes through what the industry calls nuclear winter. Nuclear winter is the capital moves out from the space, and it's like you can't raise a dollar for the sector for love nor money. The last bad one was 2000 to 2003. The end of the dot-com boom took biotech down badly to the point where the NASDAQ biotech index was down 80%. Now, that was 20 years ago. I think the gains of the last 20 years have been such that we're going to see nuclear winters being shorter and the recovery coming around more quickly. And that might be true for this particular cycle as well. And here's a chart to prove what we mean. That's the NASDAQ Biotech Index going back about 2 years. So July 2020 at the left-hand side of the chart, February 2021 at the start. Now look at that. Right about the time I was telling the folks at BioShares in May 2022 to be bearish, sure enough, we were well and truly into the bear market phase. The recovery kicks off about 2 or 3 months after that. And it's become pronounced probably since about a month before Christmas. So that's telling you that the turn is probably happening. If we kick over to the next slide, it shows what the long-term chart looks like. Basically, that's the usual kind of 35 to 40% downswing you'd get for a typical bear market in the sector rather than a nuclear winter. And so it looks like we've had that, and we're now on the recovery. So if the NASDAQ Biotech Index is any guide, and I mean those companies generally are more mature and better funded. Some of the stocks we know in life sciences here in our part of the world could be in for a good 2023.
So a quick question, Stu. How long does it take for sort of the bullishness in these more developed companies to trickle down to sort of the more speculative stuff that we see on ASX?
I give it a year or two. We're a long way from San Francisco. and our companies tend to be a little less well capitalized and a little less well understood. I mean, that's been my bread and butter now since 2002 in terms of explaining what these companies do. So sometimes, I suspect our recovery is still coming as a sector. There's no index, or at least I used to calculate my own index to show what the speculative sentiment was like. But I suspect if I reconstruct that again now, you might still see the tail end of a bear market for the kind of stocks that we know down here, with the prospect of a decent turn coming middle of the year or thereabouts. Now I've put the 4 names up there on the screen here, and I'm saying to you, watch these stocks carefully. The chart will look absolutely frigging miserable. Emphasis on the frigging for a lot of these stocks. So please listen carefully here. Do not buy these stocks. Mark, are you listening?
Yeah, I am. Yeah.
Yeah, and viewers, do not buy these stocks yet. I'm saying look carefully, because here are some potential future winners. And at the time when the chart turns, you could make out reasonably well. But the charts look terrible. Let me list 4 of them. Actinogen Medical. And there's some decent research on the Pitt Street Research website for Actinogen from work I did a few years ago. The others, if you kick around, we'll have written about those stocks in Stocks Down Under. Actinogen Medical is one I know particularly well. They've developed a new approach for the treatment of dementia, and from about a couple of years ago, we can be reasonably confident that they've got the right kind of drug at the right kind of dose. So that company is moving forward. I don't have to tell you that the people who come up with better drugs for dementia are going to make out like bandits just because of the underlying demand. And the secret to their success is basically going to be twofold. One is the agencies are desperate for drugs, so they're making it easier for those drugs to get approved. The other is they're looking for differentiated mechanisms of action, rather than the kind of stuff that's been tried for the last 20 years and been found somewhat wanting. And Actinogen has a differentiated mechanism of action in the drugs that it's working on. Chimeric Therapeutics, CHM, that's IPO'd in 2021 at 20 cents, and it's now well under 10. It's a company involved in T-cell therapy for the treatment of cancer. Very, very powerful technologies they're working on. Not dissimilar space to Prescient Therapeutics. A lot of the breakthroughs we're going to have in cancer in the next generation or so is harnessing the human immune system to go after the cancer. Prescient Therapeutics is particularly interesting to me because they take a style of cancer therapy called CAR-T, chimeric antigen receptor T cells. A bit of a mouthful, but what it means is basically engineering the kind of T cells that keep us healthy in our body to zero in on cancer cells and blow them up. CAR-T became real several years ago, and it's been making fortunes for its developers. What Prescient has is a universal kind of CAR that you can put into any patient and create more personalized medicine. It's still relatively early days, but there are multiple catalysts to unlock the value in this one. And if they crack this puzzle, they go into much bigger and better things than the kind of capitalization you've got here. Tissue therapies. I've spent a bit of time with these guys lately. They've come up with a wound care and dermatology product, and funded it in the IPO with enough money to get through phase 3. They're having an end of phase 2 meeting shortly with the FDA, and now getting ready for a phase 3. So you've got a phase 3 opportunity, but you need a magnifying glass or maybe even a microscope to see the market cap of this company compared to the opportunity. So one to definitely take a look at, because the directors were smart in terms of how they got this one funded. So that's 4. Now, Mark, you and I have known each other for years, so you know my weakness. I never saw a biotech I didn't like.
Well, I was surprised too that you said don't buy these stocks right now.
Right.
So my question immediately is, what to look out for in terms of, well, obviously the chart, but what specifically on the fundamental side? And look, FDA approval is the no-brainer for all these stocks, but what to look out for? Yeah, you want to catch these stocks just on that upside, right?
It's purely a turn on the charts. We know the technologies and these things are good. And every now and then there'll be a new paper published, or there'll be an animal study, or they'll be able to prove that they can make the drug ready for a clinical trial. And then you need to combine that with a chart that's moving in the right direction, or else you're waiting for a long time. Remember, historically it takes 15 years and several $billion of capital to develop a new drug. You get me $1 or $2 billion, and I guarantee I'll get you a new drug. But it's the 10 to 15 years. Now that's coming down over time. But if you just buy these things and wait, you might find yourself waiting for a long time. And that's historically been, I confess, my trouble as an analyst. I like these things because I can tell they're going to go places, but it's the long, long wait. And that's why I'm saying, wait for the chart to turn. Right. That's the thing. You've got to watch out for the chart, or the science will let you down. Not that the science is bad. It's waiting for other people to appreciate that science that's going to kill your portfolio if you get involved in this stuff too early.
Look, if you give me $2 billion, I just buy an island and sip margaritas all day. So,
but Mark, that doesn't do the human race any good, right? And I know you're an altruistic kind of guy.
Yeah. All right. Thanks for that, Sue. That's really insightful. So next week we'll have our third sector, which is resources. We're quite bullish on that one as well, especially with China reopening. So we'll talk about that one next week. For now, let's go to another topic. And this is sort of triggered by the fact that our customer service manager, Peter, is getting a lot of calls from both our subscribers, but also from people out of the blue that have lost their shirt on certain stocks, not stocks that we advise, be mindful of that, but stocks where they invested, they thought they did the homework and they understood it. And then sure enough, stocks came crashing down. So with some advice for people like that, and there's a lot of them out there. So that's what we want to talk about. If you want to invest in technology and life sciences stocks, talk to us first. The Chip Guy and Mr. Biotech. We've been in this sector for quite a long time, and we just wanted to give you a few examples of how things can go badly wrong if you invest in stocks that you don't really understand. So, like I said, some of our customers and also people that haven't subscribed yet to Concierge, they call us with horror stories, and they think they know a certain sector or a certain stock. They spoke to a friend who's bullish on it. They read about it on a Facebook group or Hot Copper. They went in way too hard given their risk profile or the risk profile of the stock that, by the way, they didn't really understand how risky it was. And they lost their shirts on some of these stocks as they crashed. And obviously, early stage resources, life sciences, technology, that's where a lot of this pain comes from. Not so much from the ASX 200, although there's some dogs in there as well, but especially the smaller risky stocks is where this is happening. So just this week and last week, we got calls about Archer Materials, St. George Mining, and Atomo Diagnostics. And we won't, of course, mention the stock or the name of the investor, but one of them lost 100K on one of these stocks. And these are just horrible stories when you come across them. And then, when Peter, our customer service manager, talks to these people, he says, so why the hell did you buy these stocks? And well, the obvious answer is it seemed like a good idea at the time, and a friend told me about it. But yeah, that's not understanding a stock. So the common theme here is that people don't really understand the dynamics of these sectors and stocks, and also the risks associated with them. So there's a bit of self-promotion here. But if you want our advice, have a chat to us first. As the previous presentation demonstrated, Stuart knows an awful lot about life sciences stocks. And I've been in this space, in the technology space and semiconductors for the better part of 27 years. Stuart's been doing life sciences for 22 years.
I can tell you, Mark, in that 22 years, I have seen everything, including menage a trois in the boardroom. Everything that can go wrong in the kind of sectors we know about will go wrong at some point. The grey hair you can see on my head here is having to deal with some of the fallout of that. So once you understand that, you've got a better way of being able to ask questions about what can go right. That's the first thing I'd say. The reason why you need to talk to us, and secondly, one of the things we're coming to appreciate a bit more as investors ourselves, Mark, I think you'll agree, is the importance of timing. Like I was saying a moment ago, don't just buy the stock and put it in your bottom drawer. That's a recipe for disaster. Get your timing right on a particular stock.
Exactly, and it's very specific for some of these sectors. So like you said, Stuart, you've seen everything in life sciences. I think I've seen everything in semiconductor industry.
Have you seen a menage a trois in the boardroom?
No, I haven't seen that. I would have liked to see that, but yeah. Anyway, I've seen a lot of ups and downs though in this sector. Does that count?
So stick around long enough, and you will. Where there's money, there tends to be that sort of behavior. But the wash up of it is, well, in your case, Mark, without fail, the chip industry expands its capacity. Suddenly prices go down and it looks like the end of the world.
Which is where we are right now. If you look at memory chips, for instance, especially coming out of Korea, Taiwan, prices are falling and crashing. And this is actually a good time to buy some of these stocks, right? Because everyone is being cautious right now. But this industry, instead of the usual 6 months ahead that the market looks ahead, these stocks tend to look, investors in this sector tend to look ahead up to 9 or 12 months even. So because we believe that the second half of this year, or maybe even just before that, we'll see semiconductor stocks bounce really hard. It's probably a good time to start getting into these stocks. And again, we've seen a lot of ups and downs, and this sector has got multiple verticals. It's not just memory, it's logic, and they all have their own dynamic. Then you've got secular growth in the EV related chips. So there's a lot happening, and unless you know all about that, you're bound to make big mistakes. And I guess it's the same for life sciences too.
Right. Now the other thing is as well is that you want to wait until these stocks are really, really unpopular. So the giveaway for me is if you go to a barbecue and mention an unpopular stock, and there's huge pushback from everyone. Why the heck did you why the heck do you like that piece of garbage? Is the kind of pushback. When I get that, I know I'm tentatively in interesting waters in terms of buying, of getting close to getting a bargain, basically.
Yeah, and you still need to get your timing right at that point, obviously. Right. But yeah, that's sometimes it can be a good indicator. So, in other words, check out the Stocks Down Under website. There's the phone number there for Peter Kilby, who can talk you through all this, or shoot us an email, contact@stocksdownunder. We're always happy to talk to you, or to talk about certain stocks on this webinar, and try out Stocks Down Under Concierge. Just get a free trial for 3 months, no strings attached. Just see how we do. And with that, Stu, I think we should wrap it up. And so thanks for your contribution, and thanks everyone for watching. We'll see you next week.
All right, stay well.